Vinay Jaising is joining us now, MD and Portfolio Management Services at JM Financial. Vinay, good afternoon. Thank you so much for your time. Let's first talk about this, point of contention in the market, whether markets are expensive, and if yes, what's the right way to, look at it. A lot of people are expecting some big correction. A kind of a correction would play out, then valuations will get comfortable once again, but it's not obliging. So, what's the right strategy to raise cash levels? Or to stay fully invested and walk through whatever lies ahead, because one cannot time the any correction accurately anyways.
Thanks, Ajay. Thanks for this opportunity. I would come from the camp of the latter. Stay invested in the market. The timing in the market is not as important for the time you take being into the market. If I turn back the clock 3 months ago, it was the same question. And since then to today, the markets, depending on whether it's large cap, mid cap, or small cap, are up between 12 and 20%. So it's really not worthwhile, taking a test on the market and keeping cash on. What one can always do, if your stocks have become expensive, start getting some defensive names, add names in pharma, chemicals, which have not done well last year, so that, A, valuation gets taken care of, B, you move to a bit more defensive mode, which may help you at the medium to longer term. Having said that, when you leave aside valuations, because in valuations on an absolute basis, yes, the broader index is at about 21 times 1 year forward, average is about 20, so you're pretty much there. So expect, a sideways to, as earnings trajectory moves up, 10 to 15% upside on a 1 year basis on the market. Having said that, what's really important is the indexes themselves have had significant changes. If we look at the top 100 market cap companies in India, 30 of them have changed, in the last couple of years. So there is a 30% churn in the definition of large cap itself. So nothing is really constant, but for us, what works well is look at global parameters, see where, you're seeing some pain or some positive mood points, and then do a bottom-up story to look at stocks we like to buy, maybe in small cap, maybe in mid cap, because there's just that much more basket out there, and buy it. Having said that, just one more parameter I want to put our plugs on. Let's not get carried away with the global slowdown which is happening, or the trade, of carry in Japan, just because, Japanese currency is appreciated a bit. So, the negative carry trade for Japan may not work. So, free money which people were getting from Japan to invest in other parts of the world may not be possible. So there could be a liquidity crunch in the equity markets. That's not as applicable to India, because the Indian equity markets are robust because earnings are relatively robust. This quarter may be a little bit of a question mark, but overall earnings are very robust. Second, you've seen good growth on GDP levels. Inflation is in control. The current account deficit is going down, and we think it'll become a positive number in the months to come. And third, the budget also has suggested the gliding path downward for fiscal deficit, which is hugely positive. Fourth, and most importantly, technical parameters which are, on the longer term very positive for India is retail and domestic inflows. If I were to look at just from April 1st, fiscal 25, we've seen $21 billion of inflows come up from retail/DIIs. Now, this number is already the third or fourth highest. Apart from the last 3 years, we've not crossed $20 billion for a year as a whole, and already in 4.5 months, we are that much. Now, I'm not saying multiply that number by 3, but we are going to be significantly higher this year in inflows from retail. Club that up with what's happening from FII inflows. You've seen only $1 billion from April. You've seen inflows and outflows, including last 15 days, you've seen $1 billion of outflow. We are at virtually 10 to 12 year lows of about 16.2, 16.3 levels for FIIs. That money too is yet to come in. So I think you'll see a lot of liquidity come in, and that will balance the valuation parameter which you asked for, Ajay.
Interesting, very interesting. Let's talk about some of the areas which you like. I can see specialty chemicals apart from healthcare is what you like. And healthcare in particular, the way Lupin, Aurobindo came out with the numbers, and some mid-tier ones as well, completely blew it out of the park, even after a good run up last 6-7 months. I want an opinion on this, and also specialty chemicals is drawing a lot of attention with what's happening in Aarti. The sector leader, good numbers, export numbers so far, but something went in con call. Any thoughts, not on this stock, but the space, does it still merit a look on declines?
So we like the specialty chemical space. We like the domestic formulation space. There are many companies which are contract manufacturers. So as the domestic formulation growth story keeps on increasing, these contract manufacturers keeping on getting orders from them, and the growth on the top line is, north of 15%. So that's where we like the pharmaceutical or the healthcare space. There are also, many players, or, there are players which are into global fermentation, very strong balance sheets growing at 20 to 25% on the bottom line. That also comes between chemicals and pharmaceutical space. So we like that space. Purely on specialty chemicals, since you mentioned about Aarti, here we would like to make a few comments. First, look at the space you like. Look at something which will give you an EV story in the future. Look at stocks which have corrected in the last 12 months. You'll get a couple of them. One of them we like is, say, Gujarat Fluoro. Here and you've got an EV story coming up in the future, and you've got the fluorine business, which we really like in the times to come. This is something we are very excited about. So in the specialty chemical, you just can't make a basket of, we like everything. As you mentioned, Aarti, we don't have that in our portfolio. Our analysts don't likes the other stocks much more than that, because for us, what's important is what's in the price. Most of the specialty chemicals are pricing in close to the worst. As some demand increases, as the pricing increases, these are names wherein you'll see the earnings trajectory move up. That's one. And secondly, valuations, will start inching up as well. So that's the two spaces we really like: pharmaceuticals, especially domestic, or contract manufacturers, and specialty chemicals.
I'm glad you brought that up, Gujarat Fluoro, as your buy list or your favored list, because I was talking to the management, Devan Jain, on the channel just earlier, and massive, value unlocking possibilities what the management has indicated at. The entire group is active last few days, especially the EV part of the chemicals and semiconductor, etc. Before I let you go, just a quick word on capital goods, because again, opinions got divided whether the rally here will sustain. One section says valuations are expensive, but other section says that look at ABB Cummins results this time round, barring Siemens. Results are, suggesting that things are, completely fine and robust. Where do you stand on that?
So, we are very, very overweight on capital goods and industrials. We have north of 30% of our portfolio clearly focused on, I'm just adding the word infrastructure out there as well, on this space. Having said that, what we're doing here is we're reducing our weightage. So though we will be remaining overweight in this space, some of our stocks have, especially in the defense part of it and the railways part of it, gone and hit the roof. Valuations are something we are not very excited about out there. So, we are trimming positions out there. And as I said earlier, buying the specialty chemical and pharmaceutical space. Having said that, you have lots of stocks in the capital goods and industrial space, because CapEx is the way to move for India. Let us remember that India is spending as much as 11.6 trillion rupees this year, which is the year fiscal 25, which is equal to what we spend in the year fiscal 24, plus about 1.6 trillion, which was the total amount we had spent in the year fiscal 14. So lots of investments going up, be it in power, be it in defense, be it in water, be it in rail and roads. So you've got to be here in this part of the pie, but valuations should be a very important criteria for you. So you've got to be, looking at stocks, picking up the relatively cheaper ones with good managements, strong balance sheets, and I think that's where you should be overweight on.
All right, Vinay, we'll let you go on that one. Thanks so much for joining us on the show today. We'll take.
If you like this video, then like, share and subscribe to ET Now.